My name is Arpit Agarwal. Some of you would have read my recent articles on Franklin Templeton and what happened with their debt funds. And lately I've been getting a lot of queries saying, you've talked about risk of investing. Can you explain to us in very simple layman terms, how do we estimate or how do we assess the risk in our debt funds, the ones that we are currently holding? So I thought I'll make a video, something very simple. And before I get on to explaining how to assess debt fund risk that you're holding, I'll take you away from the world of debt funds into a very different world, something that we do on a daily basis. And let's assume you have to go from point A to point B, from one city to another city, which is, let's say, 500 kilometers away, and you need to rent a car or you need to hire a car to do that. How would you do that? I've seen a lot of times you go into these taxi hailing apps and you order a taxi, and when you get a specific kind of car, you actually cancel it and rebook it. Because somewhere in your mind you start feeling that's not the car I'm going to use or I want to use to travel from point A to point B, which is 500 kilometers away. Some will even book a different car. So example, somebody will be maybe very happy with a small car, one of those small little boxy ones, and because they're cheaper, and somebody else may come back and say, no, I want a slightly longer car, I want a sedan, and it's longer, it'll be more comfortable. And somebody may come back and say, no, I want an SUV where I have seat belts, I have airbags, I have a more professional driver, the age of the driver is more mature. What's happening? In our own mind, we are assessing the risk of that journey, and some people are happy to take that risk in a smaller car to say, how many accidents happen anyway? So what are the chances of me getting hurt? And somebody else says, I don't care how many accidents happen or not. I have to make sure I am as safe as possible. So in the eventuality of an accident happening, it may not become life-threatening for me. Same thing, bring it into the investment world. There are risks associated with investing. And if I isolate those risks specifically to the risks associated with debt funds, it boils down to three broad buckets. First is interest rate risk. Second is credit risk. Third is liquidity risk. What is interest rate risk? It is the rate at which my net asset value will change with the rise or fall of interest rates. Credit risk is the ability for the borrower or the bond issuer to pay me my interest and principal on time. And liquidity risk is how quickly, without impacting the price of the security that I'm holding, I'm able to sell it in the market under normal conditions. But all of these can become complicated if you start mixing them together and assessing them at a specific fund level, and get even more complicated if you move from one category of fixed income or one category of debt fund to another. So let's leave this for the time being and let's go to another criteria, a much simpler one. That is to see how much is the sub AAA security that any scheme holds. Now what is sub AAA? Sub AAA is the rating of the bond or the rating of the paper. And when you Google, you put the name of your debt fund in Google and type the name of it and press search, you will get at least 10-15 websites which give you a snapshot or a summary of the fact sheet of that scheme. And if you look for a point where it says how much is sub AAA, it'll give you that number as a percentage. So for example, in a credit risk fund, you may find sub AAA at 30%, or in a money market fund and an overnight fund, you'll find it as 0. And that's how you can find it. Okay. Now let me give you some more data to put these things in perspective. About 2 years ago, the total AUM in the open-ended debt funds was roughly around 10 lakh crores. And it went up to about 12.5 lakh crores, somewhere in between. But today it's at about 11.5 lakh crores. So just take a ballpark number of 11 lakh crores. About 2 years ago, the whole industry, all asset management companies, all debt fund schemes, everything in the open-ended space put together had a total of about 20% sub AAA paper. And over these last 2 years, they have gradually brought it down to less than 10%. What does that mean? It means that the whole industry, all the investors put together, all the fund managers put together, have collectively reduced the risk in the portfolio of the debt fund universe. So 10% becomes your benchmark number, which means those schemes which have more than 10% in sub AAA are taking more risk than the average of the industry, and those schemes which have less than 10% sub AAA are taking lesser risk compared to the average of the industry. In the case of Franklin Templeton, however, in its total AUM of open-ended debt funds, this sub AAA paper for the last 2 years was on an average in excess of 65%, which means they were taking many times more risk than the whole industry as a whole. If you go just for these 6 funds which have got locked and which have caused about 3 lakh investors, that's what I read, and about 25,000 crores stuck for anywhere between 2 to a few years more, if you just take those 6 categories, the entire mutual fund industry in the debt fund category had a sub AAA exposure of about 35%. And that 35% number was brought down by the industry to around 20% in the last 2 years. Franklin Templeton, on the other hand, kept the exposure in these 6 schemes that got shut of the sub AAA paper in excess of an average of 80%. Their lowest, I think, on an average, all these 6 put together, was about 74%. So they were taking a lot more risk, and the industry was taking a lot less risk. And therefore, if you as an investor look at your own portfolio, because in the end, you are in charge of your own life. And if you have an advisor, even better, you have somebody to talk to, a professional to talk to, and you can consult with your advisor to understand what is the sub AAA exposure in your debt fund portfolio. And taking you back to that same example of the car which I gave you earlier, is all you can do is ensure that the vehicle that you travel in, the level of safety of that vehicle keeps increasing if your wanting not to get hurt keeps on increasing too. If you don't care about getting hurt, you don't care about what vehicle you're traveling in. But if you're careful about your life, if you're particular about your life, then you will want the safest possible vehicle at the price that you're willing to pay for it. It doesn't guarantee that an accident will not happen, but it kind of increases the probability of you not getting hurt as you improve the quality of your vehicle and the safety features of your vehicle. Same is with investing. When you invest and when you look at the portfolio of the scheme or the fund that you're investing in, you are increasing the probability of an accident not happening. And that's how simple investments is. So don't look at just returns. In addition to looking at returns before you choose a fund in the debt fund category, just look at a sub AAA number. Keep a benchmark of 10%. It also may happen that you may choose a fund which has 0 sub AAA, and some of the sub AAA or some of the AAA paper of that fund may get downgraded over a period of time to a AA or even a single A. But then you have that buffer of 10%. So if your portfolio from 0 sub AAA goes to 5%, 6%, 8%, 9% sub AAA, you can take corrective action well within the time before an eventuality of an accident. And that's how simple managing risk in a portfolio is.